Welcome back, folks. This is your CIO, Chief Investment Officer Greg Silverman speaking. Come join us for another session of Come Learn with Me, where we rate our articles that were curated over the last week and see which ones did well, which you liked, were shared, and then we read them together in a Come Learn with Me format. So this one is Unfunded Public Pension Liabilities are forecast to rise to 1.3 trillion in 2022. All right. Probably because of higher rates, maybe? I don't know. According to forecasting by Reason Foundation's Pension Integrity Project, when the fiscal year 2022 pension financial reports roll in, the unfunded liabilities of the 118 state-paid public pension plans are expected to again exceed 1 trillion in 2022. After a record-breaking year of investment returns in 21, which helped reduce a lot of longer-standing pension debt, the experience of public pension assets have swung drastically in the other direction over the last 12 months. Early indicators point to investment returns averaging around -6% for the 2022 fiscal year, which ended on June 30th, for many public pension systems. Based on a -6% return for fiscal 22, the aggregate unfunded liability of state-run public pension plans will be 1.3 trillion, up from 783 billion in 21. Pension Integrity Project funds, with a -6% return in 22, the aggregate funded ratio for these state pension plans will fall from 85% funded in 21 to 75% funded in 22. The 2022 public pension forecaster below allows you to preview changes in the public pension system funding measurement for major state-run pension plans. It allows you to select any potential 2022 investment return to see how the returns would impact the unfunded liabilities and unfunded status of the state pension plans on a market value of assets basis. So let's see, funded ratio, got it. Unfunded. So fiscal 22's investment return, where are we supposed to change? Well, let's say we end up 0, -1. Inflation adjustment on. Well, that crashed my computer, so here we are back again. The nation's largest public pension system, the California Public Employees' Retirement System, CalPERS, provides a good example of how much one bad year of investment returns can significantly impact unfunded liabilities, public employees, and taxpayers. If CalPERS's investment returns come in at -6% for 22, the system's unfunded liabilities will increase from 101 billion in 21 to 159 billion in 22. A debt that would equal $4,057 for every Californian. Its funded ratio would drop from 82.5% to 73.6% in 22, meaning state employers will have less than 3/4 of the assets needed to pay for pensions already promised to workers. Similarly, the Teachers Retirement System of Texas reported 26 billion in unfunded liabilities. If TRS posts annual returns of -6% for the fiscal year, its unfunded liabilities will jump to 40 billion, and its funded ratio will drop to 83.4. This unfunded liability per capita is $1,338. The table below displays the estimated unfunded liabilities and the funded ratio for each state as their public pension system reports -6% or -12% for 22. Basically, it's just not good, right? So it's funded ratio -6 -12. See, look at Georgia. Wow. So the funded ratio is quite volatile. It's the first 3/4 of 22 fiscal year clocked in at 0%, 3.2, and -3.4. For public pensions, according to Milliman, the S&P 500 is down more than 20% since January, suggesting that the fourth quarter results would be more bad news for pension investments. Considering the average pension plan bases its ability to fund promised benefits on averaging 77% annual investment returns over the long term, plan managers are preparing for significant growth in unfunded liabilities and a major step back in funding from 21. Well, 21 was up 20%, so you got 3 years worth of your 7%. So shouldn't be complaining too much. The significant levels of volatility and funding challenges pension plans are experiencing right now support the pension integrity's project's position last year that most state and local government pensions are still in need of reform, despite the strong investment returns and funding improvements in 21. Unfortunately, many observers mistook a single good year of returns, granted a historic one, as a sign of stabilization in what was a bumpy couple of decades for public pension funding. On the contrary, this year's returns, as well as the growing signs of a possible recession, lend credence to the belief that public pension systems should lower their return expectations and view investment markets as less predictable and more volatile. State pension plans in aggregate have struggled to reduce unfunded liabilities to below 1 trillion ever since the Great Recession, seeing this number climb to nearly 1.4 trillion in 20. Great results from 21 seem to finally break this barrier, with the year's historically positive investment returns reducing state pension debt to about 783 billion. Now, pension plans will again see unfunded liabilities jump back over a trillion, assuming final 22 results end up at or below 0%. It's important not to read too much into 1 year of investment results when it comes to long-term investing, but during this time of economic volatility, policymakers and stakeholders should recognize that many of the problems that keep public pension systems significantly underfunded for multiple decades still exist, which are, I don't say, and many pension plans are nearly as vulnerable to financial shocks as they were in the past. Going forward, state and local leaders should continue to seek out ways to address and minimize these risks, making their public retirement systems more resilient in an uncertain future. Okay. Well, it's just a lot of debt in the system, isn't there? Not much more we can say about that. I hope you enjoyed that article, guys. Please take a look at some of the links down below, get a better sense for some of the investment themes we follow, some of the outsourced CFO and CIO work that we do. And of course, subscribe and like, and join us again soon. Thanks for joining. Greg Silverman out for now.